Welcome back to the Behind the Well Show. Roger Abel back to Elias Randall. 2026 is in full effect, and we're going to talk today about one of the greatest investors of all time, currently retired Warren Buffett. I wanted to talk a little bit about some of the messaging that's come from Warren Buffett and some wisdom that he's really provided us over the last, probably 5+ decades, and key takeaways from the Oracle of Omaha. And I bring this up because he recently retired. But I think there are lessons that are out there for people to understand. And LPL actually released an article talking about the biggest points of Warren Buffett's career. And I thought we'd just kind of cover some of the highlights of what he believes from an investing standpoint and how he's went about doing it over the course of the last 50, 60+ years, because he really is known as the best investor of all time.
I like how he defines a quality business. So he says here that quality business has strong competitive advantage, consistent profitability, competent management, and can prosper in a variety of market environments. Sounds pretty high quality to me.
I believe that too. And when we work with individuals who want to buy individual stocks, because for the vast majority of people that we work with, we utilize diversified portfolios of ETFs, maybe some mutual funds, whatever the products are. But typically it's not a recommendation to an individual stock. But if an individual says, hey, I would like to own the stock, part of my questioning is, why would you want to own it? Will you own it a long time? Is this speculative in nature? And that's really what this question, I think, for Warren Buffett is. If it's speculative, I'm not going to buy it. Do I believe you can weather the storms of all market conditions? And do you actually make money? And part of my litmus test when if I buy individual stocks for myself, I typically like to be things that I use. Because most of the things I use, I believe, will be around for a long period of time.
Because you're using it?
I have a little bit of an understanding of it. I mean, if you use it every day, you kind of understand it.
That was another one of his.
Makes me feel better about giving them my money. Because I'm a shareholder. I'm an owner.
Well, and that was another one of his kind of words of wisdom. It was about investing in businesses that are easy to understand. And maybe easy is not a great word because that's kind of relative, right? Like what's easy to understand for one person may not be easy to understand for another person. But I think in general, if you can understand the business, the model, how potential economic environments would impact that business, I would imagine that's what he's getting at. Not just, I don't want people to hear easy and think, oh, it's got to be the most simple idea. There are complex businesses out there that for some people would be, like Elon Musk probably thinks understanding the business of building rocket ships is easy to understand. I probably would not have that same feeling.
I promise you I wouldn't have that same feeling.
Yeah. So that part's relative. But I think if they have all the quality characteristics that they're looking for and you can understand and you can picture how it would work, probably a decent opportunity.
Well, and typically if you can understand it, okay, we did, for most people don't have an edge in picking a stock, right? Do you know what I mean by an edge? Like some type of advantage.
Yeah, they don't. Yeah,
right.
Information other people don't have, or
well, and not even that. I don't even know if it's that, Elias. I'll give you this example. If you had somebody that worked in a particular, let's say the trucking industry, okay, they own a trucking company. They likely have a competitive advantage over most people who would buy that stock. Obviously, there's a few, but when you work in the industry, you understand the ins and outs of it better. But if I threw you and said, hey, go research this trucking stock, you could research it. You could get all the fundamentals. You get all of the numbers, all that stuff that's out there, right? But because you don't understand the inner workings of the trucking industry, you don't have a competitive advantage versus one of our clients who that may own a logistical trucking company. They don't have inside information, but they understand how that business and industry works better than most people. That's a little bit of their edge. And a lot of times when people ask about buying individual stocks, if they tell me, hey, I'm in this industry, I understand, okay, it's not a big edge, but you might have a little bit more knowledge than most people that took the stock tip from Joe the painter, which we typically see in times of...
What's wrong with taking stock tips
nothing.
from Joe the painter? Come on.
I mean, if it was about the paint company, I'd probably take it. But if it's about a microchip, maybe not. The third thing that Warren Buffett is a true believer in is invest for the long haul. And that goes back to buying quality companies. If you buy quality companies that you believe have a path to profitability and increased revenue, then you should be willing to be invested for the long haul. And it's really the only way to bring a level of certainty to your portfolio is to give it time to work.
Warren Buffett, when he goes into, here's something people should understand. His portfolio has not lacked fluctuations over the years, right? He's not someone that, my holdings have never gone down in value, but he is someone that invests for the long haul and has been very successful at picking companies to buy. That doesn't mean he hasn't experienced fluctuations just like every other investor out there. But when his portfolio fluctuates, he's an investor, so he makes good decisions in those times.
Well, he's more opportunistic. He coined the phrase, be greedy when others are fearful and fearful when others are greedy. So he always has some cash to deploy. In fact, it's made headlines the better part of the last couple of years because he's had so much in U.S. Treasury bonds. And that's his opportunity. If he sees something that they believe they should buy, it's his opportunity to get in. And, they have that Buffett index. And I saw that just hit the all-time high, which means he wouldn't potentially be buying all-time high in that index for overvalued stocks, which does that mean anything? Maybe, maybe not. We've had the discussion for a long time that if we're just working off a 50-year historical average of something, is that really relevant to the last 15 years? Because things will change, right? And the longer stocks have a higher PE, what happens to that historical average of that price earnings ratio? It's going to come up with it.
It'll go up.
It'll go up with it.
And if as investors get used to it, then it's not as, the lower number's not as important as it goes higher, and investors get used to that.
The last thing that Warren talks about, I'm on a first name basis with him, by the way. He talks about risk and says never lose money. And never losing money doesn't mean that you just hit on it. It doesn't mean that things won't fluctuate. It means that he doesn't want to, he's looking to buy assets that he believes over the long term will go up in value. In the short term, it could fluctuate because you really only lose when you hit the sell button. That's the only time that you lose.
Or lock in a loss.
Yeah, that's what I'm saying. Now, that said, and I would say that is true for the mutual fund, ETF, diversified portfolio world. It is very possible to buy an individual stock and lose it all. And I could start to list the names of stocks that used to be top best in class that no longer exist today, primarily just because of different changes in the landscape of how consumers purchase goods. As we talk about Warren Buffett and a little bit about his just massive outperformance in the market, which it's rare, right? One takeaway I have is that it requires a high level of patience to do what he did. It wasn't done in a day. It wasn't done in a month. It was done over a course of a career, or in this case, the better part of 40 years. Hartford literally just released a chart that's talking about this exact thing and how long-term returns require a massive amount of patience. And they released data going back to 1926. So 100 years of data. And since 1926, the stock market has averaged 10.49%. So inherently, when you tell people that, their expectation is that the stock market is going to make 10.5%
or whatever it was. Yeah.
This is so wild. Over the course of 100 years, the stock market's averaged 10.5%. Only 6 times, so 6% of the time, did the market make between 8 and 12. So let that sink in. Only 6 times did the market make between 8 and 12%. The rest of the time, it made something more or something less. So 94% of the time, the market doesn't return 8 to 12%. It returns something more or something less. And the vast majority of the time, the market is returning better than 12%. Before I started the show, over 100 years, and I'm going to guess you didn't count this, that's why I'm teeing you up. How many years did the market make more than 20%? Because we're getting the talk right now. We had, 23, we had a 20% year, 24, a 20% year. Last year, a little right around 16. Can it do it again? How many times did the market return more than 20%?
38.
Counted it. Is that what you counted? No, it's actually.
I just eyeballed
it. It's 34.
I just eyeballed it and guessed. But
34% of the time, the market makes better than 20%.
So 34 out of the last 100 years.
45% of the time, the market has done better than 16%. And 50% of the time, it's made over 20%.
12, you mean?
Or yeah, I'm sorry, over 12. So half of the time, it's made over 12%. Yet people are so scared of the stock market. I didn't count the negative years, but the negative years, I mean, it's only lost more than 20% 6 times.
Yeah, total
6
negative
times.
Years is 25 or 26.
It's only lost more than 12%.
So a quarter of the time,
Think about
25%
this.
of the time.
People are so scared about it. The market has only lost more than 12% in an individual year 8 times. 8 times. If you told most people, hey, a bad year in the market's going to be 10%, they'd be like, oh, yeah, I can deal with that. But people just revert back to the worst of the worst when I think about the stock market decline. But only 8 times has went down more than 12%. And so many people are so scared to be in the stock market. And it's part of it, they don't understand the numbers. They're not educated about how it really works. And
they're lacking patience.
Well, that's part of it, Elias.
And an ability to.
Part of it is they're lacking knowledge because they think, it's not that they think, they actually don't understand how the stock market is priced. They think it's just a fictitious price that goes up and down. They're not thinking about ownership in a company. They're not thinking about the way the price is derived is from the earnings of the company. I've had people tell me, well,
so how do you think the average person, how do they think the price is?
I don't think they think about that.
They just look at it and see what it is.
They say, hey, this is the price today. That's what the price is today. I don't think inherently they think about how the price is derived. If you asked
how did we get
100 people and said, how does a stock get its value? What do you think the percentage is? Someone's going to say it's based upon the earnings of the company. They're not going to tell you that. No way. They think it's a big casino, and that's part of the problem. And it's the lack of education that we've provided to people. I've had people come in here and say, well, what if the stock market goes to 0? And your gut reaction is to say, hey, that'll never happen. Right? Don't say never.
Let's talk about it. What if that did happen?
Well, it's not what if it did happen. It's what would have to happen for that to happen.
Sure,
for
let's
it
talk
to
about
happen,
that first.
It would basically mean no companies sold anything. There's zero earnings.
Sounds terrible.
But how do you get there? Like, you have to buy something, right?
I guess not.
Well, what are you going to do about food? How are you going to feed yourself? To my point,
in this scenario, no one's buying anything.
That's right. That's what makes it virtually impossible. It means every company has no earnings. Like, it means there is no economy. Your economy would be what you can grow, what you can harvest, the water you can gather on your own, no utilities, like nothing.
We're all going to be homesteaders now.
Well, I had someone I talked to yesterday about this.
And we're going to barter. We're not going to use money to transact.
But that won't happen, because when you barter, like, even then, someone's going to have more money to buy more things. Like, those are revenues. The monetary system would basically cease to exist. Like, and that wouldn't happen because it's too hard to just trade in goods. That's why money exists in all parts of life. So I'm not saying it's not impossible, but I guess explain to me how we would get to the point where nobody can buy anything. And it's hard to fathom, right?
Alien invasion.
You take us all to Mars?
Yeah.
Ship us up there.
Alien invasion.
So I think this is a great chart. If anybody wants a copy of this chart, go to btwellshow.com. You should check it out, because it is a great way to put in perspective what to expect from the stock market. And over 50% of the time, the market makes more than 8% per year. 50% of the time, it makes more than 12. Okay. It's actually 56% of the time it makes more than 8%.
Can I make one more comment on this?
For sure.
I think I don't know if maybe it's called a paradigm shift when you change the way you think. If people were to, even if you don't want to learn much about the market, I think at minimum, I want to be a stock market investor, okay, an equity investor. So really just a baseline kind of definition for yourself is this is what I'm going to buy with the money I want to invest into something. I'm going to hold these investments, and I'm just going to continue buying more because I've chosen to be an equity stock market investor. Right? Isn't that, because really, regardless of too many people get caught up in the timing and the price. And you know how many people I've talked to in the last 90 days that, well, I just know the market's high right now. Well, the price, but where the multiple the market's trading at, is that really that high?
Well,
historically, yes. But before the correction in 2022, it was in the 40s.
Hey, Elias, let's talk about, and then we're shifting gears a little bit out of the accumulation phase to, hey, what's it look like for a lot of retirees? And we've got an even mix in our office, about 50-50. If you take a look at the demographics of our office, half the people are retired, half are accumulating, which is kind of nice because we get multiple perspectives on both sides of the fence. Many times, though, I see people who are retiring really trying to figure out, where's my money going to go? And there's really 5 places where the vast majority of people are going to spend their money in retirement, and especially early in retirement. Okay, let's talk earlier in retirement versus post 80. And the large expense for most people in retirement, when they first retire, a big expense is probably going to be entertainment. I just sat down with, and when I say entertainment, I'm talking about food, stuff you do, travel, all those things. And I bring this up because I had a family yesterday that came in, and they're planning on spending $40,000 a year on travel. And you know how we break out needs, wants, and wishes. Their needs are like $60,000 a year. And that includes like their food and all their fun stuff around here.
It's fairly frugal, really.
Yeah. But they want to spend $40,000 a year on travel, and they want to buy a new car every 5 years. Like, we really dialed it out, right? And they're like, man, I don't know if I can do this. and it worked perfect. But their number one expense was going to be entertainment. And for most people, I don't think they think about it that way, because a lot of retirees just paid their house off. And for the previous 40 years or 30 years or however long they were paying on it, that was their biggest expense. Because if you ask most retirees, what's going to be your biggest expense? They're just going to revert to house because they forgot that it's paid off.
And it's the biggest expense for a big chunk of your life, unless you never get it paid off. I think having entertainment be the number one expense. I wish that was the number one expense in my household budget. I'd feel pretty good about that.
So in this family, the number two expense was food. Because they go, we want to eat out 4 times a week. They don't want to cook. And they'd figured out what they spend.
I love that. I love that about
we spend it. They go, we spend $80 every time we go out to eat. So they had $320 a week budgeted for food, which for 2 people, I think that's probably pretty reasonable. And they're probably getting an appetizer. They might be getting a cocktail.
You could spend more.
I mean, spend less if you go to Chili's, which is, by the way, my daughter's favorite place now.
Really?
London's like, Dad, let's go to the one with the big red pepper.
What is she like in there?
I think she just likes the environment. She likes a burger everywhere. She just wants a burger. It's London. She just eats hamburgers.
London.
Yeah, London just wants a hamburger. Yeah, I'll take a burger.
She's a tank.
Yeah, you're right. She's like a linebacker. Healthcare, probably an equal expense to food and entertainment. Probably around 13% of your retiree budget might go to healthcare. One of the nice things when we run a financial plan for somebody, we don't really have to guess on it anymore. We can drag in the healthcare button and automatically it'll calculate your Medicare premiums or ACA premiums pre-65 based upon your income that you're expected to have and all of those different factors. It'll bring all of that in and calculate it in the software. But for most people, they're like, man, am I really going to spend $12,000 a year in health insurance? Yeah.
Or more.
Yeah, or more. And I'm talking about Medicare age, before Medicare age, if you're on the ACA, who knows, you're probably a couple $1,000 a month or close to it. And then transportation is one that most people forget about. And we really try to get an idea for how people are going to purchase vehicles, because I'll never forget this. I had a friend of mine. I mean, he's one of my best friends today. And when his dad retired, Rockwell engineer, dad's retiring, gonna buy my last car. But he's like, what do you mean your last car? You're gonna drive this car for 30 years? Yeah, sure enough, he's had 4 since.
Driven for 30 years.
Yeah, he's been retired like a decade and he's had 4 cars since. But most people aren't thinking, hey, I should look at my car purchasing pattern and put that into my plan. Most people have a pattern that they buy cars or like a time when they trade in. Some people drive until the wheels are off, but a lot of people are like, hey, I get a new one every 3 years, every 5 years, every 7. Well, this family I was working with yesterday, every 5 years, he gets a new truck, and every 7, she gets a new Cadillac car. So guess what? We figured out what the price difference is, index it for inflation. Every 5 and 7 years, we have car purchases coming out. So we plan for those, but most people don't think about that. And he's like, well, I'm going to make payments. I said, you're not making payments. You're going to pay for a car. You have a few $1,000,000. Why would you make a car payment?
What'd they say to that?
Oh, really? I said, yeah, really. But they were planning on making payments. I'm like, there's no reason to make a payment. You have the money to pay cash. And then for some people, housing, right? So if your house isn't paid off, housing will likely be your number one expense in retirement. And one thing to remember, if your house is paid off, there's still property taxes and insurance you need to factor in. So if you have a paid for house, don't forget there's still property taxes and insurance you have to cover. Want to make sure you're factoring that into your retirement budget.
This one's a controllable factor too. Because if you do a good job preparing for retirement, hopefully your housing cost is only the property tax that you have. And if you don't own a home, which is totally fine, then just your rent that you would need to pay. But hopefully you do a good job and you go into retirement without a mortgage would be nice situation to be.
It's what should be what you do. And here's how you do it. You figure out how many years you have till you retire. So if you're 51 and you say you're retiring at 65, you go run what's called an amortization of your current loan and say, I'd like to pay it off in 14 years. And that's the payment that you make. This is totally controllable. If you're 15 years away from retirement and you're not planning on paying your house off, I'd argue that you might not be able to afford that house. And I know you have a 2.75% interest rate. Don't care. Your house is just risk at retirement. Like most people, regardless of what happened, can make the insurance and property tax payment.
So why would you argue that?
That what? Argue that most people could?
No, then you can't afford the house.
Okay, if you took a 30-year loan at 50, why did you take a 30-year loan at 50 if you don't plan on paying it off? So you buy a $600,000 place, in 15 years, you're still going to owe $400,000. Where are you going to come up with $400,000 at? Now, if you have funds that you plan on pulling out of retirement or you've been saving somewhere else, that's fine. But if you could afford the house, you'd just set up on a 15-year payment. I've done this with lots of people. You're 8 years from retirement. You have an 8-year plan to pay it off. Don't care if you have a house payment when you have income. But once you're done working, why would you want a house payment? You're just taking your investment dollars to pay for it, right? You're taking your retirement to pay for your house. So if you were able to do that, why don't you just pull your money out of retirement and pay for it? You get it done.
Yeah, I like it.
I mean, I did that. I've done this with lots of people. It's what I'll plan on doing.
Yeah. So this 5 things retirees spend 80% of their income on, right? That one can pretty easily be cut out. Maybe easy is not the right word, but can be cut out with
planning. You can't do it if you're 3 years out. It's going to be harder, right? But if you're 45 years old or 50, there's really no reason.
Should be able to map it out.
Should be able to map it out. And hey, if someone takes a 30-year loan but makes a payment so it's paid off in 20, I don't care. I think it's if you make 2 extra payments a year, 2 extra principal payments a year, takes what, 7-8 years off your loan?
Yeah, something like that.
Yeah, you could take a 30-year note and say, hey, I want to pay it off. I'm working with someone right now. They could wipe out their $180,000 mortgage today. I mean, no question. They got lots of money.
What's stopping them?
4 years from retirement. His interest rate's 2.25, and he doesn't want to pay it off. And I said, hey, fair enough. I said, but we would both agree that once you quit working, we will pay it off, right? Yeah, we'll pay it off then. Okay, great. Doesn't matter if he does now, but psychologically he doesn't want to do it. His wife wants to pay it off. He doesn't. Wife's all for paying it off. I said, well, why don't we just put a 4-year plan together to pay it off? And if it's not paid off when you retire, we pay it off. And for some people that do that strategy, Elias, it's not pay it off all at one time, because sometimes there's taxes involved. That might be a 2 or 3 year plan once they retire to pay it off. But the point is, get the risk off the table, because that's what debt adds in retirement. Debt is just risk. It doesn't mean that you can't have it. It's just how much risk are you willing to accept once you're no longer employed?
I think I would like to have my house paid off at that time. That'd probably be my answer.
Are you going to go home and tell Maddie that?
Oh, I'm sure she'll be fine with that.
Yeah, I mean, you will, because you're what, 37?
Yeah.
Yeah, so even if you took out a 30-year loan, you'd be able to pay it off early.
Yes. Yeah, just making I think
I
I was 30 or 31 when we refinanced, because rates went low. So still, even at that rate, I'll be 61 or 62 years old.
Well, see,
without making extra payments.
That's the trap people fall into in their like late 40s, early 50s. They go buy a new house because typically that's when you have the most money, right? If you're like, that's when I see lots of people buying their like last house, and at 48, they take a 30-year mortgage.
Their castle.
Yeah, well, they don't think about they're not thinking about I'll be 78 because the bank just says this is what you should do. You could take the 30-year mortgage and just accelerate the payments a little bit. But, for some reason, 30 is the default. If you talk to Dave Ramsey, he's a 15-year guy. I understand if you want to take a 30 to have flexibility, but you should still make the payment to get it paid off. The interest amount's drastically different.
I bought my first house for $75,000.
You did?
Yeah.
You wish you still owned it?
Yeah.
Me too. Every house I've ever sold, I wish I still owned. But at the time, I couldn't afford to have multiples. But I do wish I still had my first 2 homes that I had.
I wish I still lived there.
Yeah, I don't.
I do.
I mean, both my places were really nice. I mean, the one place our first house, we built that house. It wasn't big, but it was nice. It's not far from where we live now. My house that I had before this one, I really liked that house. In general, I liked the house. It wasn't big. It was maybe like 3,000 square feet. I didn't love the location. If I'd have had that house and the location I am now, I don't know as if I would have sold it, to be honest with you.
Yeah, my first house, there was a location issue. Not the best neighborhood to raise a family in.
I've always been fortunate. We've been in pretty good neighborhoods. In fact, that's what keeps us at our house now.
Yeah.
We have an
we live in a nice neighborhood now. It's nice because it's kind of out in the country and everyone's got their own space. And
you are a country guy, kind of. Maddie likes it out there.
Yeah.
In general, you guys want space. We're a little opposite. We like to be really close to amenities, I guess.
Wouldn't bother me. Wouldn't bother me.
With that said, I want to thank everybody for listening to the show today. If somebody has a question, comment, you want to answer it on the air, please go to btwellshow.com. If you're looking for help getting started on a financial plan or just want a second set of eyes on what you're doing, reach out to one of us. We'd be happy to sit down and talk with you. On behalf of Elias and myself, I want to thank you for listening.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options, each choice offering advantages and disadvantages. Those options include leave the money in their former employer's plan if permitted, roll over the assets to their new employer's plan if one is available and rollovers are permitted, roll over to an IRA, or cash out the account value. Consult your tax professional about eligibility to Roth and traditional IRA contributions. Contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59.5 and has held their Roth IRA for at least 5 years. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA.